Okay.
Yeah.
Good morning, everyone. This is Marshall Gittler bringing you the morning comment for November 26th. With just one day ahead of the OPEC meeting, impromptu talks between Saudi Arabia and Venezuela with non-members Russia and Mexico ended without announcing any kind of agreement. On top of this, the signals sent by individual member nations thus far suggest there's little consensus on whether to reduce output. OPEC could agree on stricter enforcement of the existing production quota of 30 million barrels a day, but with no individual country quotas, such an agreement would probably be meaningless unless Saudi Arabia agreed to act once again as the swing producer. I think that's highly unlikely that they'd resume that role. Nor is it clear how non-OPEC members would react to any such agreement. It looks to me as if oil prices are likely to continue to fall, particularly against the background of a slowing Chinese economy and stagnating European economy, and continued high U.S. domestic oil production. Now, the third quarter U.S. GDP was revised up yesterday to 3.9%, even though the market had expected the figure to be revised down. The economy in the second and third quarters posted its best back-to-back growth in 11 years, offering new evidence that the U.S. economy has substantial momentum. Nonetheless, bond yields fell and Fed funds rate expectations retreated, probably because the U.S. Consumer Confidence Index fell from its highest level since October 2007, and the Richmond Fed Manufacturing Index declined from an almost 4-year high. The mixed data and lower bond yields weakened the dollar against most of its major peers. However, I'd continue to view any dollar setbacks as providing renewed buying opportunities, since the alternatives within the G10 are becoming less and less attractive. As for today's schedule, the second estimate of UK third quarter GDP is forecast to be the same as the preliminary estimate, confirming a modest slowdown in the country's growth. With this release, we'll get the expenditure details for the first time, which will give us more information about the third quarter growth. The release, as forecast, should be neutral for sterling. We've also got data coming out from Norway and Sweden. Please take a look at the comment on our website if you trade those currencies. The main feature today will be the busy day in the U.S. We get a lot of data for October. Durable goods orders are forecast to fall on a month-to-month basis, but at a slower pace than in the previous month. On the other hand, durable goods, excluding the volatile transport equipment sector, are estimated to rebound from September. Personal spending is forecast to have rebounded as well, fueled probably by income gains amid a stronger U.S. labor market. Pending home sales and new home sales are likely to confirm that the housing sector is growing again after a soft summer. And the Chicago PMI and the final U of M confidence index, both for November, are also coming out today. Also, the day is likely to be dollar supportive, and I'd expect to see the dollar rally on the news. Then overnight, the New Zealand trade deficit for October is forecast to narrow somewhat, but following yesterday's fall in the 2-year inflation expectation rate, which makes a rate hike less likely, the moderate narrowing in the deficit probably won't be enough to reverse the negative sentiment towards Kiwi, and I remain bearish towards the currency. For more information, including technical analysis, please read the full comment on IronFX.com. You can also follow us on Twitter, like us on Facebook, subscribe to our YouTube channel, or circle us on Google+ to get more trading ideas. This is Marshall Gittler, head of Global FX Strategy at IronFX Global, wishing you solid trading.